Imagine waking up to a world where financial freedom isn't just a pipe dream, but a tangible reality, where the sweet sound of dividends hitting your account replaces the clink of coins in your pocket. This is not some unattainable goal. It's achievable, just as different people have different ideas about what it means to retire comfortably. There are many different financial scenarios to think about. Some may investigate reversing mortgages, selling assets, or relocating to a more affordable area. But there's another option that frequently goes unnoticed: living off investment dividends. Stay tuned as we'll share 3 quick ways to reach that goal. So, what's the secret sauce for figuring out your ideal investment account? It all boils down to your ideal way of living and, of course, the figures. Although the average man does spend roughly $67,000 annually, that may not be the best benchmark for you, which you can now modify in accordance with your unique requirements, goals, and comfort level. Imagine living a life where your investments produce a steady stream of income, enabling you to enjoy the results of your labors without compromising your principles. Let's add a hint of mystery to this. It's similar to having an undiscovered money tree that continually bears fruit and gives you passive dividends. Let the numbers lead you to the investment amount that will make dividends your ticket to financial freedom. Take a moment to envision your future and the kind of life you want to lead. The possibilities become alluring. Keep in mind that this journey is about finding the balance that aligns with your dreams. In this video, we'll talk you through how to reach the goal of $35,000 annually. But first, let's take a look at dividends and how they work. Suppose you own some stock in a company, and when that company makes money, you have a choice as to what you want to do with it. If the company chooses to give the profits to its owners, which, in the case of publicly traded companies, are shareholders, it calls dividends. As a shareholder, you would receive a portion of that profit based on the number of shares you own. Dividends may be paid out as cash, by check, or digital deposit, or they may be reinvested in additional company stock. Although dividend payments are made on a variety of schedules by companies, many now make them every 3 months. Now, let's discuss dividend yield. Dividend yield is a simple metric to determine how much dividends you receive in relation to the price of your stock. For example, if a stock is valued at $100 a share and you receive $10 in dividends each year, the dividend yield would be 10%. Dividend yield can vary from company to company and even change over time for the same company. Generally, more established companies offer higher dividend yields than smaller, newer ones. You'll often find that by knowing dividend yield, you can compare stock prices and make informed decisions about how much risk you're willing to take on when buying dividend-paying stock. For anyone interested in earning passive income, dividends could be a very compelling strategy to consider. It's a way to grow your wealth over time and live off the income generated by your investments. Now, let's dive into 3 easy strategies that can help you reach your financial goals through dividends. You have the potential to earn regular income without needing to sell your shares, which means you can enjoy a steady stream of money while still keeping your investments intact. The first strategy is to invest in covered call ETFs. These special funds give investors the chance to profit from both stock appreciation and dividend payments. And they're one of the easiest ways to live off dividends. But how well does it function? In order to generate additional income, the ETF invests in stocks and also writes call options on those same stocks. Call options grant the buyer the right, but not the obligation, to purchase a stock at a specific price within a certain time frame. As a result, the ETF sells call options on the stocks in its portfolio. It receives premium income in the form of dividends. Additionally, if the stock price rises above the call option's strike price, the ETF may realize capital gains as it will need to sell those stocks. Some well-known covered call ETFs to take into consideration are XILD, Oil K, and EWZ. Let's look at the 12-month trailing yields of these funds, which offer appealing yields that are frequently in the double digits and significantly higher than the yields in many traditional dividend stocks. The yields for Xyld, Oil K, and EWZ are 11.83%, 11.82%, and 11.81%, respectively. These ETFs are attractive because they can generate income from both dividends and option premiums, which creates a more steady and consistent flow of passive income. However, it's important to realize that these ETFs have certain risks, such as those associated with options, may become worthless or the stock price may drop, which would affect the performance as a whole. Let's apply this method to your journey now. To invest in covered call ETFs and earn $2,900 a month, which is $35,000 annually, we can adjust the figures based on current yield levels. You would need to invest between roughly $280,000 and $310,000. That sounds pretty appealing, doesn't it? Especially when compared to traditional dividend stocks, where you would need to invest about $2 million to achieve the same level of income. It does not require a large investment to reach a financial goal of $35,000 annually or $2,900 a month. You can investigate covered call ETFs as a way to realize your goals of living off dividends and achieving financial independence. If you are keen to starting down this path, this strategy offers the chance to create a consistent income stream while lowering the amount of capital. Let's look into an additional avenue for you to receive dividend payments of $35,000 annually. This approach entails making investments in unique businesses known as real estate investment trusts, or REITs. For you, there are some excellent reads to contemplate if you want to earn passive income from dividends. These include Two Harbors Investment Corporation, which has dividend yield of 20.3%, Brandywire Realty Trust, which has dividend yield of 19.9%, and Orchid Island Capital Incorporated, which offers a dividend yield of 19.4%. REITs are similar to teams that invest in real estate properties like malls, offices, and apartments. These teams make money from these properties and share some of it with investors. The amount of money you get from REITs can fluctuate depending on the number of tenants and the state of the economy. While REITs can yield higher returns than regular stocks, they can also be riskier during weak economic times. Therefore, if you want to invest $35,000 annually from REITs and expect to receive an average annual return of 10.8% over the next 20 years, you would need to invest roughly $320,000. If you remain dedicated and patient, you can become financially independent. You should have a plan in place before investing in dividends. Knowing your goals and the amount of money you need will help you select the best REITs for your portfolio and ensure that you stay on track over time. Since every person's circumstances are unique, you might discover that you can live comfortably on less than $35,000 annually. Or you might require more if you have a family or a certain lifestyle preference. One wonderful thing about REITs is that, in contrast to ordinary stocks, they frequently pay dividends each month. This makes them an even more alluring option for investors who want a reliable stream of income from the stock market. And finally, on to number 3, we have Dividend Aristocracy Payout. Aristocrats are special stocks that are part of a group of companies in the S&P 500 index. These hawks are regarded as excellent choices for individuals who wish to generate income from their investments because they have a remarkable track record of raising dividend payments and shareholders for at least 25 years in a row. Some of the leading dividend aristocrats include 3M, Leggett & Platt, and Walgreens. These companies typically pay a dividend yield of almost 7%, which is lower than that of covered call ETFs and REITs. To be included in this group, a company must have raised its dividend payout for at least 25 years in a row. Aristocrats are known for reliably raising dividends year after year. Whether investing in these stocks is a good idea depends on your personal goals timeline and how much risk you're comfortable with. Aristocrats come from a variety of industries, but they have a few characteristics in common, aside from raising dividends on a regular basis. These are well-established businesses that have demonstrated growth over time. They're typically large businesses that are less likely to be acquired by other businesses, and they also typically perform better during difficult economic times, which helps them generate consistent profit. So how much money do you need to invest to reach the goal of $2,900 a month? Well, taking into account a 7% dividend yield, you need to invest $5,000 in order to be completely independent. While this may seem like a sizable amount compared to a traditional dividend stock, which would require an investment of $2 million, this is a fraction but with the same payout. You would be better off spreading your investment across multiple dividend-paying companies. Alright, and that's going to do it for today's video. Thanks a lot for watching, and y'all have a great day.